and welcome to Fidelity Connects. I'm Pamela Ritchie. Bond and equities continue to attract strong inflows in these markets. And for the first time in a long time, international equities have been selling on par with U.S. equities, signaling certainly a shift in where investors are putting their money. How are changes in global fiscal policies, especially in Europe, impacting international investment strategies? And with more investors seeking diversification, perhaps than ever before, how can Fidelity All-in-One ETFs help clients balance their portfolios? Joining us here today to unpack all of these issues and more is Fidelity Director of ETFs and Alternative Strategy, Étienne Joncas-Bouchard. Étienne, a pleasure to speak with you. How are you?
I'm doing very well, Pamela. Thanks for having me back on the show.
Delighted to have you here. With this type of investing broadly, we'll look at the all-in-ones, but we'll look at sort of some of the quant strategies behind them. It does actually allow you to not get so whipsawed, right? Because you're not following as an individual sort of the emotional headlines.
It is such a great point, and it's a certain comfort or a peace of mind where it seems like when you're building strategies systematically, you're selecting stocks with quantitative capabilities. You're looking for data points. You're looking for fundamental characteristics of these various companies that we're looking to select. It doesn't really have an impact on what is being said on a daily basis about tariffs here, tariffs there, changes in rhetoric from a political standpoint, anticipation of what might happen or what might not happen. We just completed a rebalancing phase for many of our products at the end of February, and guess what? We rotated the portfolio into stocks that, for our value ETFs, were attractive on valuation. For quality, that we're showing great traits for profitability, constant earnings, high margins. That's not impacted by a lot of these headlines. So there is some comfort there, right? It's a double-edged sword to a certain extent where, we're looking at historical data. We're relying on what these companies are showing us right now, but it definitely does provide that comfort.
I'll just push a little bit on that. The fundamentals, the discussion of tariffs, which we won't spend too long on here, but is that, it'll hit a consumer, it'll hit businesses. They may or may not pass that on, which may or may not be great or terrible or neutral to the consumer or to the business. But over time, it could hit earnings, which of course is fundamental, which is what you're looking at to make decisions from a fundamental basis. When you're making decisions today or, in February, when you're taking a look at things and doing fundamental investing, I guess just how do you grapple with that? You have to make decisions, I guess, based on now, but, there is a fundamental story sort of eventually.
No, absolutely. And that's why markets, that's why there's a bit of volatility. That's why there's markets. The markets are moving, there's anticipation that things might, impact the bottom line of certain sectors, certain businesses. And there are metrics that we can look at from, a quantitative standpoint in factor ETFs that are forward-looking. You can look at something like a forward price to earnings, which considers, analyst consensus estimates on earnings. So there are areas where you can look forward, but for the most part, we're looking at current data and historical data. There's ways to implicate it for sure, but it's just when you're looking at, for example, valuation metrics, you're not necessarily going to consider what potentially might happen down the road, right? You're trying to figure out what has value opportunities currently, and hopefully those materialize over time. And it just allows for sound portfolio construction over time. To not change the approach, right? We're consistently applying the same process regardless of the environment that we're in. Yes, certain factors will perform better depending on the environment, but it's not going to change the way that the strategy operates, right? So if you're buying a value ETF, it's always going to be trading at a discount relative to the benchmark. If you're buying a quality ETF, your average return on invested capital will always be higher that of the broad market. So, the word comfort that I was saying earlier, it's just you kind of know what you're going to own from a broad perspective. You don't know exactly the underlying names that you might own because that will change throughout this, throughout every business cycle, throughout various market cycles. But you know that the characteristics of the portfolio will remain, right? You know that the exposures you are going to get from a key characteristic standpoint, if you will be the same.
That is actually very comforting. It has sort of the sleep at night quality to it. Let's talk a little bit about flows. We mentioned it there in the introduction that we've seen a shift. There's a big question about U.S. exceptionalism, and the European trade has been ripping for year to date. It's been certainly one of the big stories of this year. There's a lot of them to grapple with. But tell us about flows.
Yeah, no, absolutely. We could, this is a slide that many of you might have seen before. It's our, kind of monthly review on what's been sold and bought in the Canadian ETF industry. If we could put that up, it's our first slide. It's been a really good start to the year, albeit, sentiment seems like investors are showing a little bit of defensiveness and maybe a bit of, no, I wouldn't say worry, but, definitely questioning around risk taking. We do see equities leading the way at about 8.3 billion in net new flows. This is as of the end of February. Fixed income also continued to do well at 6.9 billion. You see the multi-asset category, which the all-in-one ETFs that we have here fall into that category. Those continue to be very popular among investors and advisors. So overall, it's been, once again, like the Canadian ETF industry has just shown so much resilience over the past 5 years. Even in a year like 2022, there was positive net flows. So. And that also accounts for the breadth of products, right? So regardless of how investors are looking to position themselves on from a risk appetite perspective, there's likely a product out there for you in the Canadian ETF industry. So I think that's one of the great things about where we play right now is that breadth for sure. And I guess the one point that you were mentioning, Pamela, which is the international equity side, I think that's kind of the story of the flavor of the month, if you will, to certain says, or definitely a change in trend. U.S. equities had been dominating flows for the last, I'd say, 13, 14 months. And you've definitely seen so far year to date significantly more appetite to add international exposure. I think there's a few reasons to that. Obviously, international markets are performing well. The second point also is that a lot of Canadian investors have been really underweight that geography, if you will, for a very long period of time with, maybe not an argument to be made not to have done so, but I think we're seeing now that added demand for a region that's decorrelating from, the U.S., for example. So it's an interesting area, and we can definitely get a bit deeper into that subject, but I constantly every day get requests from either our sales team, advisors, institutional investors looking for more information on solutions that we have here at Fidelity, to invest internationally, and we do have a bunch, obviously.
And I'm just curious about some of the questions and sort of then flows themselves, which are kind of the evidence. Is it all Europe?
So that includes emerging market, like that. Flows number includes emerging markets. It's going to include Europe. It's going to include, Asia Pacific. But so it's anything basically ex-US, ex-Canada. So it's a bunching of everything. It's tough to, unless we go granular and really start to look at, individual ETFs. It's kind of tough to differentiate between those.
Dip into the sort of history of how things were termed a little bit, because I think probably over a decade ago, when you spoke about diversification, that would often mean geographic diversification, and making sure you're sort of spread out across the world, and lots of discussions of sort of currency benefits one way or the other. It then, I think, in the U.S. exceptionalism years, which we may well still be in, tended to mean more be different sort of asset allocations, but perhaps all in North America, just between different asset classes. Now it does seem to be fanning back out to diversification geographically. Is that, do you see that? Is that fair?
Absolutely, it's fair. If you look at a global portfolio right now, you are seeing the true benefits of having that geographic diversification this year, more than the past 3 to 5 for sure. There's so many things that goes into that is, even the change that we've seen over the past 15 years, let's say, from a globalization standpoint, we've never been more integrated. There's never been more global companies operating across the world where, it seems like it was easy to make arguments that it was not necessarily worthwhile to diversify from a geographic standpoint. And then, as history tends to repeat itself, where you have, return to means, which we are nowhere near a return to, say, an average valuation or average return from, say, international markets versus the U.S., which you mentioned had this exceptional 10 to 15-year run, like we're still far from that. But you see little signs now that it's like, okay, maybe this is not necessarily, the next 10 years might not look like the past 10 years, especially if, you're hearing, rhetoric on things like, let's protect local industries. Let's not necessarily close borders, but let's try to focus more internally instead of how do we, not optimize, but look to make trade as efficient as possible. Like it could mean more than it has in the past 10 years to diversify globally. Definitely, I truly believe that.
You mentioned earlier breadth, and within the spirit of diversification, valuations in the U.S. and in certain particular parts, obviously the sort of the top and large cap, have come down a fair amount. So just talk about diversification, if you don't mind, going back to breadth and finding other areas. But just the story of valuation has been extraordinary, as we all know, over the last couple of years. How do you diversify away from that? How do you catch it?
No, absolutely, and it's something we've talked about at length over the past, since the end of 2022, really.
Where everything went down.
Right?
Yeah.
Where everything kind of went down in 2022, but then what rallied the market in 2023 and 2024 was, pretty much the same type of stuff. Mega cap growers, the Mag 7 became a huge part of the index. Now you've seen that trade start to go on stall. And it's, those stocks are still trading at a premium, but at a significantly less large premium than they used to. So actually to start this year, a lot of the talk remains very similar to that is, I don't necessarily see a global recession and I'm just talking out loud with conversations that we have is, we don't necessarily see a global recession that's impending, but where's the risk? The risk might be valuation risk. You have markets that are trading at, premiums relative to history, with the exception of basically Europe is at its historical average. But that, when you look at the US, which is at a sizable premium, that seems like a value opportunity. But the same can be said for, if you're buying US stocks, like our US value ETF was trading at a significant discount relative to the broad market. We're talking a forward PE of about 13 to 14 times. I mean, that's not a valuation risk. It's maybe, yes, you're still investing in the US, so there's still probably, effects that you will get if the US market lags, but you do not have the impact of valuation compression that you've seen in the top part of the index. And we've seen, those types of mandates work really well so far this year. So
interesting. There's
always ways to diversify.
It really is a shift. Let's dig into the all-in-ones themselves. And I mean, maybe just briefly remind everyone, we're talking about factors, talking about diversification, put that all together. And the spirit of the all-in-ones is to capture just exactly what you've been talking about. But let's go there and talk maybe a little bit about some of the changes too, but just remind us how they put all this together for clients.
No, absolutely. If we could put up slide 2, this is another classic slide that we tend to always bring back up, but it does help explain the construction of our all-in-one ETF portfolios, which I think it's fair to say now are the flagship of our ETF line, or the kind of flagship part of our lineup, if you will, at Fidelity. They represent about half of our flows year to date, so we're extremely happy with that. Thank you, everybody who supported them. But these portfolios are kind of the epitome of diversification. You're getting exposure to various asset classes, bonds, equities, even a little bit of crypto. You're getting geographic diversification. You have, in every one of those factor allocations that we have, so low vol, high quality, momentum, and value, we have a US strategy, a Canadian strategy, and an international strategy that gains exposure to those individual factors. So these portfolios have been constructed to be simple to use for advisors, systematic rebalancing. They offer broad diversification. And ideally, long-term, we want to generate excess returns. We're still trying to outperform broad market cap weighted index or broad, portfolios that group up broad market indices. So, and sorry, to your point, I would definitely address it. We did add 2 new mandates to the portfolio so far this year. And the thinking behind those 2 products are both U.S. fixed income focused strategies. That was an area we felt we could add a little bit to the portfolio where, the lion's share of the fixed income exposure is Canadian. So we saw an opportunity to diversify that a little bit and add some U.S. exposure. So those two new mandates, the absolute income ETF fund and the core U.S. bond ETF, have been added so far year to date. We did that during our yearly rebalancing period in January.
So let's talk a little bit about that yearly rebalancing period, because I guess it's just good for you to spell out like how tactical you can be, and tactical at this moment can be one of those sort of catching a falling knife moments, or not. It can
Hopefully
be
not.
opportunities. But just talk about the rebalancing. It's just once a year, and that's what you added this year. Why just once a year, I guess, is the question.
Yeah, there's a multitude of reasons. Yes, I guess to your point, the portfolios are not tactical in nature, where we're trying to move to say, let's overweight equities, let's overweight fixed income in different periods, let's change our geographic mix. Like, these are set up to have a strategic asset allocation mix, if you will. But we do need to respect risk profiles, right? So we have if you will, parentheses of deviation that we allow, which is a 5% deviation to any asset class, or for crypto, it would be the double of the base allocation. And then we would trigger rebalancings. But if not, we rebalance once a year just to bring it back to the neutral mix if there are deviations. And when I say if there are deviations, it's because as we go throughout the year, when we do receive inflows, we're not buying the neutral mix. We're buying the ETFs that have lagged in the portfolio. And if we were to get outflows, we would buy the ones that have, we would sell, the ones that have outperformed, to always constantly try to keep us at that neutral mix. And it's an effort to once again, to manage risk, but also from if I'm an advisor, that appeals to me because I know that, a 60-40 won't become a 70-30 without me noticing, and something can get flagged on my end.
So so more access for those investors who want to have some U.S. Exposure to fixed income, that's now available. What about other asset classes? Like, how would you term those? We're talking a lot about different cap spectrums these days because the Mag 7 have come down, and so there's questions about whether you take a look at mid caps, take a look at other places. How do you account for that?
Yeah, no, I mean, like once again, we're trying to touch everything here. We try to leave no stone unturned, if you will. We do have exposure to small caps via our global small cap opportunities fund and ETF. So that's an actively managed solution that's as part of the portfolios. Once again, that mandate was not added from a tactical standpoint. It was added from a long term. We would like to have exposure in the small caps. And this management team has done an exceptional job. So let's add them in the portfolios. And they've been additive from a relative contribution standpoint ever since we have added them. So it's been a great allocation to have.
What's that mean, relative contribution standpoint? What do you mean? So
in the sense that they've outperformed their benchmark since we've added. So once again, going back to the fact that it's a strong management team and the portfolio's done really well. And because of that, albeit it's a small allocation, it's been additive to our absolute return and relative returns to our benchmark. And the other main asset class I'd say, or difference that we have in these portfolios, say relative to peers, is we do have 1 to 3% allocations into Bitcoin in the portfolios, which is an asset class that has historically offered diversification to traditional assets. And that's been additive, obviously, over the past 2 years. But when we did launch the portfolios in 2022, it was a slight drag on performance also. But we do it in a risk-managed way so that it's not taking away from the rest of the great things that we're doing in the portfolio.
Interesting. Just back to what you added, a bit more fixed income, a bit more. How much Canadian exposure is there in these? Lots of Canadians invest, and they do. I think we have a bias. Well, you'll tell us. There is a Canadian bias. We tend to buy things that are from our country. That may have been less so over the last few years. But how do these portfolios stack up on that front?
Yeah, so it's I guess to give the overall picture is a bit tough. But the way that I break it down is like if we separate equities and fixed income, it's a bit easier. So if we look at equities, about 50% of our equities are U.S., 25% Canada, 25% international. Excuse me. If we look at the fixed income side, about 75% is Canada, about 10% is global, and about 20% is U.S. Okay. So that's give or take the split that we have. all in all, I think it's around like a 40 Canada, 40 US, 20 international, maybe a bit less international than that. But that's broadly what we're looking at in these portfolios.
And when you look at, I mean, you don't need to look too much into sort of the landscape of competition, but it is interesting to note, like, to what extent is the strategy that you're employing here with the all-in-ones, does it have competition? And, how would you discuss the differentiation there?
Yeah, no, absolutely. I mean, the main competition are kind of the classic, let's call them plain vanilla type market cap weighted index portfolios, or passive ETF portfolios, and those are you're combining your for your U.S. exposure you buy your S&P 500, for your Canadian exposure it's the S&P TSX, for your international it's usually the MSCI IFI or some type of FTSE ex-US index. You got a bit of emerging markets, a bit of bond indices in there, and that's pretty much the makeup of our main competitor portfolios. Obviously, they'll vary from firm to another, but with our approach, we have no passive exposure, if you will, in our portfolio, or passively managed strategies other than Bitcoin, obviously, which we're not we're not trading. We're just tracking the price of Bitcoin. The rest is every other strategy in the portfolio is trying to outperform, right? It's trying to generate excess returns. And we're doing that through stock selection for the most part. So if we look at like some of the main competitor portfolios, they'll have more than 20,000 individual holdings in their portfolios. We have a lot, but we're at around 2,200 to 2,500. So to a certain way, a way to explain it, the work that we're doing, both quantitatively and actively, is to filter down this massive investment universe and bring it, take the top decile, if you will, right? So let's try to get a bit more concentration. I mean, I don't think anybody could argue that 2,200 names is concentrated, but relative to our peers, I mean, that's 1/10 of the size of the number of names that we hold. And that's how, in the long term, we hope to generate value for investors.
Factors actually are, I mean, they're either better, but they're different, perhaps, than what, because we don't always think of REITs being in momentum.
Yeah, a lot of investors actually, kind of give us that statement is, momentum is growth. Momentum is not growth. Momentum is whatever's having positive change. So, yeah, it doesn't have to be, full of technology companies and comm services and consumer discretionary. It can go anywhere. It's going to be dependent on where earnings are getting better. It's going to depend on where price change is going to get better. As well as we also incorporate in our strategies, we're looking at companies that have low short interest, right? So we don't want companies that are heavily shorted in the portfolio.
Okay, so interesting how you put that all together. Ultimately, let's just kind of come back to the discussion of live markets. A lot of commentary throughout the day, of each day, and the sleep at night factor. I mean, these are people's investments for their entire retirement. There's an element of being concerned about what's going to be said or done next. Just kind of bring us back to that. We started there. The elegance of quant investing, in the sense that it takes out a lot of the emotion.
Yeah, no, that's a great way to put it, Pamela. I think it's having these systematic and quantitative strategies as part of the investment mix for investors allows to have a very different approach, right? Is we are constantly picking and selecting stocks based on important fundamental characteristics, right? Or valuable fundamental characteristics, regardless of what's happening in the media, what's happening in the news, what you're seeing on various news outlets and TV shows. We're still there doing the same thing, trying to find great stocks with these factor models, and they will continue to do that. They're not thinking of what might be or what can't, what might happen down the road in 6 to 12 months. Yeah. It's just trying to find good stocks.
Okay, so just speak to those who would think maybe I'm, it's the old, don't become uninvested, make sure you stay in the market. But there, this is one of those moments where people are like, oh, just go to cash, or you want to be in something incredibly diversified that allows you to kind of ride this out. For, I guess, kind of the throw out message to investors who are thinking, maybe cash is simpler.
Yeah, no, I think it's, it's I think the best message is definitely diversification, and we're seeing it right now. right, is you have very different return streams in global markets, and it's similar to, and I guess maybe this is kind of like a metaphor or analogy. I don't know how you describe it exactly, but good farmers generally won't plant all their seeds in the plot of land that has the best soil necessarily, or the one that's going to yield always the most, because you never know what can happen in that one plot of land. You'll spread it out. Maybe you'll have a little bit lower yield in another area, but if a tornado hits or a tree falls in that field, at least you've got something else on the side that's growing. And I think that's a valuable lesson right now to spread out, spread the eggs out of the basket a little bit. Don't leave them all in the same one. We're seeing that volatility right now, and I think investors that were diversified are seeing this and looking at the returns of their portfolios and saying, oh, what's all this noise about? Like, my returns aren't that bad right now. Like, it's not that bad. And I maybe I'm an optimist, but I think it's been extremely valuable this year to have diversification.
Okay, it's fantastic to speak with you at a moment like this, Etienne. Have a great weekend ahead, and thank you for sharing your time.
Absolutely, thank you as well. Have a great weekend.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.